Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host here at AlgoBot, and in today's video, we're exploring an expert advisor called Percent Range Trend Pullback. This is a trend-following strategy that waits for a healthy trend to form, then looks to join it during a temporary dip or rally, using the Williams percent range oscillator to time the entry. By the end of this video, you'll understand how the strategy defines a trend, how it times its entries, and how it manages risk on every trade. Everything here is for education only, so let's dive in. So what exactly does this expert advisor do? At its heart, Percent Range Trend Pullback is a trend-following system. Rather than trying to predict tops and bottoms, it waits for the market to establish a clear direction, and then it aims to join that move during a temporary pause. The strategy is built around two ideas working together: a trend filter and a timing tool. The trend filter is an exponential moving average, set to 50 periods by default. But the strategy asks for more than price simply being on one side of that average. It also requires the moving average itself to be sloping, rising for an uptrend or falling for a downtrend, measured over a short look back of a few bars. Requiring a genuine slope helps screen out the flat, choppy conditions where pullback entries tend to get whipsawed. For timing, the strategy uses the Williams percent range oscillator. This indicator measures where the current close sits inside the recent high-to-low range. In a healthy uptrend, price rarely stays deep in that range for long, so a dip that pushes the oscillator into oversold territory often marks a temporary pullback rather than a reversal. When the oscillator then curls back up, the strategy reads that as buyers resuming control at a more favorable price. This approach is designed with the foreign exchange majors in mind, such as Eurist or PUST, or an index, typically on the 15-minute to 1-hour time frames. That makes it a swing or trend-following style, not a rapid scalping tool. It suits traders who prefer to trade with the prevailing trend and are comfortable holding positions through normal market noise. As always, remember that trading carries risk, and losses are a normal part of any strategy. This is educational information, not financial advice. Let's walk through the mechanics step by step. The strategy only evaluates its rules once per closed bar, which keeps its decisions stable and avoids reacting to every flicker inside a forming candle. First, it establishes direction. For an uptrend, two conditions must both be true. The closing price must be above the exponential moving average, and the moving average now must be higher than it was a set number of bars ago. For a downtrend, the mirror applies: price below the average, and the average now lower than before. Only when the trend is confirmed does the strategy move on to look for timing. Next comes the entry timing from the Williams percent range oscillator. The strategy does not act on a simple touch of a level. It waits for a genuine crossover. For a long, the oscillator must have been below the oversold line on the previous bar, and then close back at or above that line on the signal bar. On top of that, the signal bar itself must close higher than it opened, confirming that buyers stepped in. When the trend is up and all of those conditions align on the same closed bar, the strategy signals a long entry. The short side is the exact opposite. In a downtrend, the oscillator pokes above the overbought line, then curls back down through it, and the signal bar closes lower than it opened. The oversold and overbought lines both come from a single pullback depth setting, which keeps them symmetric. With the default depth of 20, the oversold line sits at -80 and the overbought line at -20. Now let's cover risk management, which is all based on average true range, so it self-scales to any symbol or time frame. The initial stop is placed a multiple of ATR beyond the entry, below price for a long and above price for a short. The take-profit target is set as a fixed reward-to-risk multiple of that stop distance, with a default of 1.8. Finally, once a trade moves into profit, an ATR trailing stop ratchets the stop in the trade's favor and never loosens it, aiming to lock in gains if a trend runs while still leaving the target room to be reached. Only one position is held at a time, and a spread gate skips entries when trading costs are unusually high. Let's look at the actual MetaTrader 5 code driving this expert advisor. At the top are the input parameters you can adjust in the strategy settings. TrendEmaPeriod sets the moving average length at 50. Slope Pullback at 3 controls how many bars back the slope is measured. WPAR period sets the Williams percent range lookback at 14, and pullback depth of 20 defines the oversold and overbought lines. Below those you can see the ATR period and the risk settings, the stop multiple, the reward ratio, and the trailing multiple, along with the spread cap, the lot size, and the magic number. Now the logic. The strategy first builds two direction flags. Uptrend is true when the signal close is above the moving average, and the average now is above its earlier value. Downtrend is the reverse. Then it builds the two timing conditions. The long condition checks that the previous oscillator reading was below the oversold line, and the current reading is back at or above it, with the signal bar closing up. The short condition mirrors that around the overbought line, with the bar closing down. In the long block, when both the uptrend and the long condition are true, the code reads the ask price as the entry, places the stop multiple of ATR below it, and sets the take profit at the reward ratio times that stop distance above entry. It then calls trade.buy with those stop and target levels. The short block is the mirror image. It reads the bid, places the stop above entry, sets the target the same distance below, and calls trade.sell. Clean, symmetric, and readable. Let's bring the whole strategy to life on this illustration. Across the top you can see the price candles with the trend moving average drawn through them. And in the panel below is the Williams percent range oscillator, with its overbought line near the top and its oversold line near the bottom. Start on the left. The first couple of candles are pushing higher, and the moving average beneath them is sloping upward. That satisfies the strategy's trend filter for a long. Price is above the average, and the average itself is rising. So for now the strategy is only interested in buying a dip, not selling. Watch the third candle. Price pulls back sharply, closing lower, and in the panel below the oscillator dives down beneath the oversold line. On its own, that dip is not a signal. The strategy is deliberately patient. It wants proof that the pullback is ending, not just that it happened. That proof arrives on the very next candle. Price closes back up, higher than it opened, and the oscillator curls up and crosses back above the oversold line. Now every condition agrees on the same closed bar. The trend is up, the oscillator has crossed back up out of oversold, and the bar closed higher. This is where the buy entry marker appears. The strategy reads the ask price as its entry, and immediately places a protective stop a multiple of average true range below it, sitting just under the recent pullback low. From there, follow the next few candles higher. Buyers carry price up, one green candle after another, and the oscillator climbs toward the overbought end of its range. Because the target was set at a reward-to-risk multiple of 1.8 times the stop distance, price reaches the take-profit marker as the move extends. The long trade is complete. The strategy entered on weakness inside a rising trend and exited into strength. Notice, too, that had the trend run even further, the ATR trailing stop would have been ratcheting up behind price the whole way, protecting open gains. Now the picture changes. After the peak, price rolls over. A couple of candles close lower, price slips below the moving average, and the average itself begins to slope downward. The trend filter has flipped. This is now a downtrend, and the strategy switches to looking only for a short, selling a rally rather than buying a dip. Watch the corrective bounce toward the middle right of the chart. Price rallies for a candle, and in the panel below the oscillator pushes up above the overbought line, near -20. Again, that alone is not enough. The strategy waits for the rally to fail. On the next candle, it does. Price closes lower than it opened, and the oscillator curls back down and crosses beneath the overbought line. Everything aligns on that closed bar. The trend is down. The oscillator has crossed down out of overbought, and the bar closed lower. The sell entry marker appears here. The strategy reads the bid as its entry and places its stop a multiple of ATR above entry, just over the recent rally high. Then follow the final candles down. Sellers take control, price steps lower bar by bar, and the oscillator slides back toward oversold. Price reaches the short take profit marker, completing the second trade. The strategy sold into a temporary rally inside a falling trend and covered lower. Put the two trades side by side, and the symmetry is the whole idea. In an uptrend, it buys a dip once the oscillator confirms the dip is ending. In a downtrend, it sells a rally once the oscillator confirms the rally is ending. The trend filter decides the direction, The Williams percent range decides the timing, and the ATR-based stop, target, and trail manage the risk on every trade. Of course, not every signal plays out this cleanly, and losses are a normal part of trading. And that brings us to the end of our breakdown of the percent range trend pullback expert advisor. We covered how it defines a trend with a slope-filtered moving average, how it times entries using the Williams percent range oscillator on a pullback, and how it manages every trade with ATR-based stops, targets, and a trailing stop. Remember, this video is educational information only and not financial advice, a recommendation, or a solicitation to trade. If you found it helpful, please like the video, leave a comment with any strategy you'd like us to analyze next, and subscribe for more MetaTrader 5 strategy breakdowns. You can find more over at www.algobot.live. Thanks for watching, and we'll see you in the next one. Past performance does not guarantee future results. Trade responsibly.